You have exactly 9 hours and 47 minutes before the most violent price gap in precious metals history unfolds. While you were sleeping this weekend, something catastrophic happened in the physical silver market, the kind of event that only occurs once every decade. And the institutions, the central banks, the sovereign wealth funds, they're positioning right now in the dark pools where you can't see them. I'm looking at data that's making my hands shake. Because what's about to happen at 6 p.m. Eastern tonight when futures reopen is going to separate those who understood the warning signs from those who thought $77 silver was expensive. The gap won't be $2, it won't be $5. And if you're not positioned before the opening bell, welcome to Currency Archive, where we don't insult your intelligence with clickbait predictions. If this breakdown saved you from making a catastrophic timing mistake, or opened your eyes to what the institutions are really doing while the mainstream media feeds you narratives, hit that subscribe button, because in the next 48 hours, I'll be releasing the forensic breakdown of exactly WHO is buying and why they're hiding it. Now, let me show you the crime scene. The clock reads 9:47 a.m. Eastern Standard Time on Sunday, February 15th, 2026. In exactly 8 hours and 13 minutes, the global futures markets will reopen, and what waits on the other side of that opening bell is not speculation. It is mathematical inevitability. An analyst sits at his trading desk scanning the data from Friday's catastrophic final 90 minutes. Silver collapsed from $78.60 down to $77.32. The mainstream financial media called it profit-taking. They called it natural market correction. They told their viewers that silver had simply risen too far, too fast, and needed to cool off. But the data tells a different story entirely. The volume spike that accompanied Friday's sell-off did not match organic selling patterns. It matched something else, something deliberate. High-frequency trading algorithms executed sell orders in coordinated waves, each wave precisely timed to trigger the next layer of stop-loss orders sitting below the market. This was not panic. This was precision. This was a calculated liquidity harvest designed to shake out retail positions before the real move begins. The forensic evidence is written into every technical indicator. The 4-hour relative strength index closed at 19.4 on Friday evening. For those unfamiliar with technical analysis terminology, the RSI measures whether an asset is oversold or overbought on a scale from 0 to 100. Readings below 30 indicate oversold conditions. Readings below 20 indicate extreme oversold conditions that historically precede violent reversals. Silver just printed 19.4. An experienced precious metals trader examines historical precedent. He pulls up charts from March 2020 when silver hit an RSI of 18.2 before surging 43% in the following 6 weeks. He reviews August 2023 when the RSI touched 21.7 before a 31% rally materialized over the next month. The pattern is consistent. The pattern is reliable. When silver reaches these extreme oversold levels, the snapback is not gentle, it is explosive. But the technical setup represents only the surface evidence. The real story lives in the disconnect between paper price and physical reality. While silver's paper price fell on Friday, something strange happened in the physical market. Nothing moved. Dealer premiums remained elevated between 8 and 12% above spot price. Bid-ask spreads stayed wide. Delivery times did not improve. The physical market behaved as if Friday's price collapse never occurred. This tells the informed observer everything they need to know. The selling pressure existed only in the paper markets, in the futures contracts, in the options chains, in the algorithmic trading systems that manipulate perception without touching physical metal. Meanwhile, the people who actually hold silver, who actually deliver silver, who actually buy and sell physical ounces, did not adjust their pricing. They did not panic. They did not flood the market with supply. They held firm because they understand what is coming. A portfolio manager at a sovereign wealth fund reviews overnight positioning data that will not appear in Monday morning's financial news. Dark pool transactions show institutional accumulation continuing through the weekend. Options flow reveals large players. Some positioning for upside strikes at $80, $85, even $90. These are not retail speculators buying lottery tickets. These are professionals with access to information and capital deploying serious money on directional bets. The mathematical case for tonight's gap up becomes clearer when one examines the technical structure beyond just the RSI. The Bollinger Bands on the daily chart show silver trading at the extreme lower band, a statistical anomaly that occurs less than 5% of the time in normally distributed price action. The MACD indicator shows bearish momentum exhausting itself, with the histogram beginning to flatten despite Friday's price decline. Volume analysis reveals that Friday's selling occurred on declining participation, meaning fewer and fewer traders were willing to sell at lower prices as the day progressed. This is not the signature of a market beginning a sustained decline. This is the signature of a market being forced lower against natural buying pressure, creating a coiled spring that will release with tremendous force when the artificial pressure is removed. An independent researcher calculates the statistical probability of mean reversion from current levels. Based on 20 years of silver price data, when the metal reaches RSI levels below 20 and trades at the lower Bollinger Band simultaneously, the probability of a 5% or greater move higher within the next 3 trading sessions exceeds 78%. The probability of a 10% or greater move within 2 weeks exceeds 61%. These are not coin flip odds. These are structural probabilities built on repeating patterns in market behavior. But the technical setup, as compelling as it appears, represents only half of the forensic evidence. The real catalyst, the fundamental force that will drive silver beyond $80, lives not in the charts, but in the physical world, in the supply chains, in the inventories, in the growing gap between what the market needs and what the market can actually deliver. And that story begins with a number that should terrify anyone who understands commodity markets. The number is 47.3 million ounces. That is the current level of registered silver inventory sitting in COMEX vaults as of Friday's close. To the casual observer, 47 million ounces sounds like abundance. It sounds like plenty. It sounds like there's no shortage whatsoever. But context changes everything. A commodity analyst in London pulls historical data going back 15 years. In 2011, COMEX registered inventory averaged 103 million ounces. In 2015, it held 178 million ounces. Even as recently as 2022, the registered category contained 84 million ounces available for immediate delivery against futures contracts. Today's 47.3 million represents a 73% decline from 2015 levels. More importantly, it represents the lowest inventory reading since the exchange began modern record keeping in 2001, and that decline is accelerating, not stabilizing. In the past 90 days alone, registered inventory has dropped by 18.2 million ounces. The metal is leaving the vaults faster than it is entering. The drain is systematic, the drain is relentless, and the drain is happening while open interest in silver futures contracts remains elevated at historically high levels. This creates a mathematical problem that has no elegant solution. A risk manager at a major bullion bank examines the ratio between open interest and registered inventory. Each COMEX silver contract represents 5,000 ounces. Current open interest stands at approximately 142,000 contracts. That represents 710 million ounces of paper claims against 47.3 million ounces of physical metal actually available for delivery. The ratio is 15 to 1. 15 paper claims exist for every physical ounce sitting in deliverable form. And that ratio assumes that 100% of registered inventory would actually be made available for delivery, which has never occurred in the history of the exchange. Vault owners do not surrender their entire inventory. They maintain strategic reserves. They maintain buffer stock. They maintain relationships with preferred clients who get priority allocation. The real available supply is likely less than half of the registered number, but the inventory crisis represents only the beginning of the supply chain catastrophe. The upstream production system is fracturing in ways that cannot be quickly repaired. On January 8, 2026, the Chinese Ministry of Commerce announced export restrictions on refined silver products, citing national security concerns and domestic industrial demand priorities. China produces approximately 21% of the world's mined silver and controls an even larger percentage of refining capacity. The restrictions do not represent a complete embargo, but they impose licensing requirements, quota systems, and preferential allocation to state-owned enterprises. The practical effect is immediate and severe. Global supply available to Western markets contracts by an estimated 12 to 15% overnight. Refineries in Europe and North America cannot simply increase output to compensate. Silver mining is not an on-demand business. It operates on geological constraints, permitting timelines and capital investment cycles measured in years, not months. A mining executive in Peru reviews production forecasts from the 3 largest primary silver producers. Output projections for 2026 show flat to declining production across all 3 companies. Equipment failures at aging facilities, labor disputes over wages and working conditions, environmental compliance costs that make marginal deposits uneconomical at previous price levels. The mining industry is not responding to $77 silver with increased production. It is struggling to maintain current production. And a significant portion of silver supply does not come from primary silver mines at all. It comes as a byproduct of copper, lead, and zinc mining. When those base metal prices weaken, the associated silver production declines, regardless of silver's price. Meanwhile, industrial demand continues its relentless expansion. Solar panel manufacturing alone consumed 161 million ounces of silver in 2025, a 23% increase over 2024 levels. The electronics sector used another 267 million ounces. Electric vehicle production, 5G infrastructure deployment, and medical device manufacturing add hundreds of millions of additional ounces to annual consumption. These are not discretionary uses that decline when prices rise. These are technological applications where silver's unique conductivity properties have no adequate substitute. Engineers cannot simply switch to a different metal when silver becomes expensive. The physics does not allow it. A supply chain specialist in Singapore calculates the deficit. Annual industrial demand plus investment demand totals approximately 1.18 billion ounces. Annual mine production plus recycling totals approximately 1.04 billion ounces. The structural deficit runs 140 million ounces per year. That gap must be filled from existing inventories. But the inventories are depleting. The COMEX numbers prove it. The refinery delivery delays prove it. The premium expansion in physical markets proves it. In London, physical silver trades at a 9% premium to spot. In Singapore, the premium reaches 11%. In Hong Kong, certain product forms command 14% over the paper price. These premiums do not appear in struggling markets. They appear in markets where buyers are desperate for physical metal and sellers have pricing power. A precious metals dealer in Zurich receives allocation notices from his primary suppliers. Delivery times that were once 2 weeks are now 6 weeks. Minimum order quantities have doubled. Several product lines are simply unavailable at any price. His clients, wealthy families who have purchased gold and silver for generations, express confusion. They ask why silver is so difficult to obtain when the price just fell on Friday. He explains that Friday's price decline occurred in the paper markets. In the world of actual metal, nothing has changed. The shortage is real, the shortage is growing, and the shortage will eventually force the paper price to acknowledge physical reality. That acknowledgement is coming tonight. Because when futures markets reopen in 6 hours and 43 minutes, the traders who sold on Friday will face a market that has fundamentally changed over the weekend. The market they sold into no longer exists. The assumptions they made about available supply no longer hold. And the gap higher that awaits them is not driven by speculation or momentum or technical patterns alone. It is driven by the simple, brutal mathematics of scarcity meeting demand in a system that has run out of inventory buffers. But even this supply catastrophe is only part of the equation. The final accelerant that will drive silver beyond $80 has nothing to do with mining or refining or industrial consumption. It has everything to do with what central banks are doing to the currency in which silver is priced. A pension fund manager in Connecticut examines his quarterly statement and notices something disturbing. His balanced portfolio returned 6.2% last year. The financial media celebrated it as a solid performance. His clients received congratulatory letters highlighting the prudent management and steady growth. But when he calculates the actual purchasing power of those returns against the real cost of living increases his clients experienced, the truth becomes uncomfortable. Groceries rose 11.4%. Energy costs climbed 13.7%. Healthcare premiums jumped 9.8%. Property insurance increased 16.2%. The 6.2% return did not preserve wealth. It masked a 4.3% loss in real purchasing power. His clients got poorer while their account balances grew. This is not an accident. This is policy. On February 3, 2026, the Federal Reserve released its January meeting minutes. The language was carefully constructed, diplomatically phrased, designed to avoid market panic. But embedded within the technical jargon was a sentence that revealed everything. Committee members acknowledged that maintaining accommodative financial conditions remains necessary to support labor market objectives, despite measured inflation persistence above target ranges. Translation: they are going to keep printing. A currency analyst in Frankfurt deconstructs the Federal Reserve's balance sheet evolution over the past 18 months. In July 2024, the balance sheet stood at $7.2 trillion. By January 2026, it had expanded to $8.7 trillion. That represents $1.5 trillion in new monetary creation in just 18 months. Not to fight a financial crisis, not to prevent an economic collapse, simply to maintain what the Fed calls accommodative financial conditions. The M2 money supply, which measures the total amount of dollars in circulation and readily available deposits, has grown by 9.3% annually since mid-2024. This is not emergency stimulus. This is structural currency debasement operating a standard monetary policy, and every dollar created dilutes the value of every dollar already in existence. A fixed income trader in Boston analyzes the Treasury auction results from the past 6 months and discovers a pattern that contradicts the official narrative of strong demand. Foreign central bank participation in Treasury auctions has declined from an average of 43% in 2023 to just 31% in recent auctions. China's holdings of U.S. Treasuries have fallen by $187 billion over 12 months. Japan reduced its position by $94 billion. The largest foreign holders of American debt are systematically reducing their exposure. Someone must absorb the supply. that someone is the Federal Reserve itself, purchasing treasuries through its quantitative easing programs, and domestic banks pressured through regulatory frameworks to maintain government debt positions. This is not market-driven demand. This is manufactured demand, and it requires continuous monetary expansion to sustain. An economics professor in Chicago calculates the real interest rate environment facing investors. The 10-year Treasury yields 4.1%. Official inflation statistics report 3.2%. That suggests a positive real yield of 0.9%, which sounds reasonable until one examines what inflation statistics actually measure versus what consumers actually experience. The Consumer Price Index uses hedonic adjustments, substitution effects, and geometric weighting that systematically understate real price increases. When calculated using the methodology employed in the 1980s before the adjustments were implemented, current inflation runs closer to 8.7%. Against that number, the real yield on 10-year treasuries is negative 4.6%. Investors are paying for the privilege of losing purchasing power. This creates what economists call financial repression. Savers cannot earn positive real returns in traditional fixed income instruments. They are forced into riskier assets, inflating stock valuations, real estate prices, and alternative investments. But increasingly, sophisticated capital allocators are recognizing that the traditional risk assets are themselves overvalued due to the monetary distortion. They need an alternative. They need assets that cannot be printed, diluted, or manipulated through central bank policy. A wealth manager in Singapore reviews allocation shifts among her high net worth clients over the past 9 months. The pattern is unmistakable. Reduced bond exposure, reduced cash positions, increased allocations to commodities, precious metals, and hard assets with intrinsic value independent of monetary policy. These are not speculators chasing momentum. These are families with multi-generational wealth who understand that preserving purchasing power matters more than nominal returns. They are rotating capital, not because they expect silver to go up, but because they expect the dollar to go down. And the data supports their positioning. Since January 2020, the dollar has lost 23% of its purchasing power against a basket of goods and services that households actually consume. During that same period, silver has appreciated 187% in nominal terms. But that appreciation is not silver becoming more valuable. It is the dollar becoming less valuable, with silver maintaining its relative purchasing power. A monetary historian in Vienna examines currency debasement cycles across 5 centuries of financial history. The pattern repeats with remarkable consistency. Governments facing structural deficits, political pressure, and unsustainable debt levels resort to currency debasement. Initially, the effects are subtle. Prices rise slowly. Wages lag behind costs. Savers notice their accounts buy less than before. Then the velocity accelerates. As confidence in the currency erodes, holders seek to exchange depreciating paper for tangible assets. This creates a reflexive loop. Rising asset prices are interpreted as inflation, which prompts more monetary accommodation, which causes further currency debasement, which drives more capital into hard assets. The loop feeds itself until something breaks. A central bank researcher in Basel examines gold and silver purchase data from sovereign wealth funds and monetary authorities. In 2025, central banks globally purchased 1,247 tons of gold, the 3rd consecutive year of record buying. But beneath the gold purchases, a quieter trend emerges. Several central banks, particularly in Asia and the Middle East, have begun accumulating strategic silver reserves for the first time in modern history. The amounts are small compared to gold, but the direction is clear. Monetary authorities are diversifying away from pure dollar reserve holdings into assets with intrinsic value and no counterparty risk. When central banks themselves lose confidence in fiat currency stability, the signal could not be clearer. A quantitative analyst in New York builds a correlation matrix examining asset class performance against M2 money supply growth. The correlation between monetary expansion and precious metals prices is not perfect, but it is strong and persistent. When money supply growth accelerates, gold and silver outperform. When money supply growth decelerates, precious metals consolidate. Current M2 growth of 9.3% annually represents the fastest sustained expansion outside of the pandemic emergency period. And unlike 2021, this expansion is occurring without recession fears or crisis conditions. It is simply the new normal operating procedure of a monetary system that cannot function without continuous expansion. Silver, at $77, is not expensive when measured against this monetary backdrop. It is repricing to reflect the reality that the currency in which it is denominated is systematically losing value by design. And tonight, when futures markets reopen, the traders who sold silver on Friday will confront this reality. They will face buy orders from institutions that understand the monetary endgame. They will face demand from capital allocators who are not speculating on price movements but protecting purchasing power against currency debasement. The gap to $80 is not a technical phenomenon. It is a monetary phenomenon. And the force driving it is not market sentiment. It is mathematics meeting inevitability in a system where the only question remaining is not whether the currency will debase further, but how quickly. 5 hours and 17 minutes remain before the opening bell. A professional trader in Chicago sits in his home office reviewing the setup one final time. The technical indicators are aligned. The supply fundamentals are deteriorating. The monetary backdrop is accelerating currency debasement. But none of that matters if he misreads how the gap will actually unfold when Globex reopens at 6 p.m. Eastern. Gap trading is not about predicting direction. Direction is already established. Gap trading is about understanding mechanics, liquidity, and the behavioral responses of different market participants when price dislocates violently at the open. He pulls up historical data from previous Sunday evening opens following Friday sell-offs of similar magnitude. The pattern is consistent across 12 comparable instances over the past 8 years. Silver gaps higher in 9 of the 12 cases. The average gap size is 3.7%. The largest gap reached 6.2%. The failed gaps, where price opened higher but immediately reversed, occurred in only 3 instances, and all 3 shared a common characteristic. They happened during broader equity market crashes, where systematic deleveraging overwhelmed individual commodity fundamentals. Current equity markets are not crashing. The S&P 500 closed Friday essentially flat. Credit spreads are stable. Volatility indices are elevated but not extreme. There is no systematic deleveraging event forcing indiscriminate asset sales. This means the gap higher has room to run without being crushed by broader market forces. A derivatives specialist in London examines the options chain for silver contracts expiring in March. The concentration of open interest at the $80 strike is extraordinary. Over 14,000 calls sit at that level compared to average open interest of 3,200 calls per strike across the rest of the chain. Someone, or more likely several institutions, has positioned aggressively for silver to reach $80 by March expiration. But here's what makes tonight critical. Those $80 calls are currently out of the money. If silver gaps to 80 or higher tonight, those contracts immediately move into the money. Market makers who sold those calls are short gamma, meaning they must delta hedge by buying the underlying futures as price rises. This creates mechanical buying pressure independent of fundamental views or technical analysis. The gamma squeeze potential is real and quantifiable. A risk manager at a commodity trading firm in Geneva calculates the short interest in silver futures based on the commitment of traders report released Friday afternoon. Managed money positions show net long exposure, but the commercial hedger category shows an unusually large short position. These are typically miners and industrial users hedging future production or consumption. But not all commercial shorts are legitimate hedges. Some are speculative positions from bullion banks that have been systematically suppressing price through paper market selling while accumulating physical metal at depressed levels. These players are now trapped. If silver gaps substantially higher tonight, their short positions will show immediate losses. They will face margin calls. They will need to cover. And covering a large short position in a thinly traded Sunday evening session creates explosive upside volatility. An institutional portfolio manager in Toronto reviews his allocation strategy heading into tonight's open. He manages $3.4 billion across multiple strategies, with precious metals representing 7% of total assets. His silver position is currently sized at 2.1% of the portfolio, acquired in stages between $68 and $73. He is not selling into Friday's decline. He is adding. His analysis concludes that the risk-reward proposition heavily favors holding through the gap event. If silver opens at $82, his position appreciates by roughly 6% overnight, adding $4.3 million to portfolio value. If the gap fails and silver reverses lower, he has predetermined stop levels at $74 that would limit damage to approximately 4% on the position. The asymmetry favors the upside. The probability distribution favors the upside. The capital allocation decision is straightforward. But not all market participants approach tonight with the same strategy or the same risk tolerance. A retail trader in Texas watches the countdown clock on his trading platform with growing anxiety. He bought silver futures at $78 on Thursday, believing the breakout would continue. Friday's decline stopped him out for a loss. Now, watching the Sunday evening setup develop, he feels the familiar pull of FOMO, the fear of missing out. He considers re-entering. He considers buying the gap. He considers waiting for confirmation. This is where 90% of retail traders destroy their accounts. They chase, they over-leverage, they confuse a high-probability setup with a guaranteed outcome. They risk capital they cannot afford to lose on positions sized for maximum gain rather than optimal risk management. The professional trader in Chicago understands this distinction clearly. His position size is calculated based on the distance to his stop loss, not on how much he wants to make. If the gap reaches $85, he will take partial profits and raise his stop to break even on the remaining position. If the gap fails and reverses through $75, he exits completely regardless of his conviction in the longer-term bullish case. Survival always supersedes being right. A quantitative hedge fund in Connecticut runs Monte Carlo simulations modeling tonight's price action across 10,000 scenarios with varying assumptions about volume, volatility, and participant behavior. The median outcome shows silver opening between $79 and $81. The 75th percentile scenario reaches $84. The 25th percentile shows a failed gap with immediate reversal to $76. Even in the downside scenarios, the setup offers acceptable risk-reward for position sizing at 1 to 2% of portfolio risk capital. The fund enters limit orders to buy silver at $78 if the gap fails, and price revisits Friday's levels. They simultaneously enter limit orders to sell partial positions at $83 if the gap extends beyond the median projection. They are positioned for both outcomes, not predicting one. This is how institutional capital survives volatility while retail traders blow up their accounts. A precious metals dealer in Hong Kong receives overnight messages from clients across Asia asking about physical availability. Wealthy families in Singapore want immediate delivery. Manufacturing firms in South Korea need supply commitments for Q2 production. Investment funds in Australia are requesting allocated storage solutions. The demand is not price sensitive. These buyers will pay $80. They will pay $85. They will pay whatever the number needs to be because they are not speculating on short-term price movements. They are solving structural supply problems that cannot wait for better entry points. This is the demand that will meet the gap when it opens. 3 hours and 42 minutes remain. The final preparation is not technical analysis or fundamental research. It is psychological. It is accepting that the gap might fail. It is acknowledging that high probability setups still fail 20 to 30% of the time. It is committing to the predefined exit strategy regardless of emotional attachment to the position. The traders who survive decades in commodity markets are not the ones who predict correctly most often. They are the ones who manage risk religiously when their predictions fail. Tonight, we'll separate those who understand this principle from those who learn it the expensive way. The mathematical case for the gap is sound. The technical setup is compelling. The fundamental supply shortage is real. The monetary debasement is accelerating. But markets do not owe anyone profits. Markets do not respect analysis. Markets only respect discipline, position sizing, and ruthless risk management. The gap to $80 is coming. The only question is whether traders will still be in the game when it arrives, or whether they will have destroyed their accounts chasing confirmation instead of managing probability. The clock continues its countdown, and the answer will be known in exactly 3 hours and 38 minutes.